Hey guys, it's Kyrill Asatur Centerfin Capital, and this is our collective weekly for the week ending April 19th, 2024. As always, we like to highlight a handful of things for you that we thought were interesting as it pertains to markets and investing. This week, we're going to talk about earnings season, which kicked off in earnest this week with about 66 of the S&P 500 companies reporting. So we'll discuss what trends we're seeing and some of the observations we have about that. Second, we'll discuss the Federal Reserve, which had 8 speakers this week talk about Federal Reserve policy and what we might glean from that. Obviously, very important. And last but not least, we'll talk about the escalation in the Middle East conflict between Iran and Israel and what that might mean for markets in general. Starting with earnings season. Earnings season obviously happens 4 times a year where publicly traded companies report their earnings for the prior quarter. It is an opportunity for us to get an insight into fundamentally what is happening with companies. And as Benjamin Graham once said, in the short run, the stock market is a voting machine. In the long run, it's a weighing machine. And what he was really referring to there was that in the short run, there are many things that could influence the price of a stock. Liquidity could be going in and out, buying and selling happening all the time based on noise and based on macro factors. But in the long run, the fundamentals of how the company is doing is actually what really reflects on its stock price. Whenever earnings come out, it gives us an opportunity to see how companies are actually doing. Ultimately, as companies grow earnings, so do their stock prices. This week, we kicked off the latest earnings season, and we saw a couple of interesting trends to highlight. About 66 of the S&P 500 companies reported this week. 77% of those companies reported a gain, beating their expectations by an average of about 7.1%. Growth has come out on the top line at about 5.7%. Expectations were only about 0.5% growth. Margins are improving, and we think that, generally speaking, earnings have been strong. That being said, what we saw on the back of several earnings announcements from big companies was stock price moves that were not expected. For instance, JP Morgan, Netflix, Taiwan Semiconductor all reported strong earnings this week, but the stocks were down post-announcement. On the other hand, United Health reported a weak quarter, but the stock was up significantly after the announcement. In the airline space, we saw Delta and United reporting this week. The earnings were really good, better than expected, and really good guidance gave a strong bid to the stocks. What are we seeing? There's been a lot of positioning in the stocks ahead of these earnings, which may be contrary to fundamentally how the companies are doing, at least in the short run. What does that mean in layman's terms? Expectations might have been too high in some stocks and too low in other stocks. That's really all it means. Over the long run, we need to pay attention to how companies are doing and how they're performing. But over the short run, you see the volatility in stocks post-earnings announcements because maybe expectations were too high or too low. Oftentimes, the way a stock reacts is not an indication of what the market thinks about the earnings themselves, but potentially an indication of what the expectations were and how far expectations got away from the fundamentals. Generally speaking, we saw margin improvement. As we said, companies had put pressure on costs. Margins have improved. And the trends in AI, at least from Taiwan Semiconductor, continue to be strong. The one trend that we think is interesting is airlines show that there's continued demand for travel, even though prices for plane tickets have been very high, as we all know. Still early, but some positive trends, and we'll see how all of this plays out. As it pertains to the Federal Reserve, we had 8 speakers from the Federal Reserve this week, including the chairman, Jay Powell. One of the trends that we noticed is that they seem to be walking back expectations of a significant amount of rate cuts for this year. As a reminder, when we started this year, the Fed had come out and said we expect about 3 rate cuts this year based on their what's called dot plot. The market was expecting closer to 6 to 7 rate cuts. That being said, the bond market on the short end of the curve, so the Fed only controls the overnight rate. The rest of the bond market trades as a market, so it trades based on supply and demand. And the 2-year bond has been a good leading indicator of what the Fed might actually do, even better than the predictive markets on the Federal Reserve rate and even better than the Federal Reserve itself. And the 2-year bond has actually been moving up since the beginning of this year. It started this year at 4.25%. And it's currently trading at just around 5%, which really means that the short-term bond markets have not been anticipating as many rate cuts as the predictive markets and as the Fed themselves have been talking about. This week, it was really the Fed of coming back to what the market has been leading and telling us all along, which is we might not get as many rate cuts as we expected because inflation seems to be sticky and the economy seems to be strong. Jay Powell basically said that the recent inflation data, which we talked about last week, which has been coming higher than expected, might not necessitate cuts anytime soon. And so if you look at predictive markets, which again have not been right all along, but the chances for a May or June rate cut are very low right now, and we still have a coin flip basically for July. The closer we get to the election, the more political the Fed might seem in cutting rates. And so we think that they'll probably not want to cut right before the election because it would seem to favor the incumbent president. But it's been an interesting year in that in December, Chair Powell said, look, we're cutting rates, where he almost gave the kind of mission accomplished speech. But ultimately, inflation has not continued to come down. It's actually accelerated. The economy has been strong. The job market has been strong. We might not see cuts. Interestingly, we actually even saw John Williams spoke on Thursday, and he even talked about could there be potentially a hike in the future if inflation continues to be a problem, which was not even part of the conversation a couple of months ago. UBS came out this week and basically said that there's some probability that the Fed has to hike rates to 6.5%, which again would have been unthinkable even a couple of months ago. Interesting development. Obviously, interest rates drive everything in the economy and drive everything in the stock market. It's really important to pay attention to, and we seem to be going through a change here that's important to highlight. Last but not least, we saw an escalation in the Middle East conflict. As you recall, unfortunately, there was an attack on Israel by Hamas in October. Everybody understands that Iran is behind Hamas and some of the other organizations in the Middle East that are waging war against Israel. A couple of weeks ago, Israel attacked an Iranian consulate in Syria, killing some of their elite army officers. Iran responded this past weekend by sending, for the first time since 1991, a foreign nation actually shot projectiles into Israel. It was, I think, over 330 projectiles and drones. They were mostly all shot down by Israel, US, UK, France, and Jordan. There was no significant damage, although some missiles did hit some army bases in Israel. There were no casualties, thankfully. The markets over last weekend panicked. The only market that was open was obviously crypto, and so Bitcoin sold off on that news. However, come Monday, things seem to have to calm down and everything recovered. Although the markets have been weak this week, it does not seem that it's on the back of this geopolitical tension, but it seems it's more related to rates and potentially earnings and positioning ahead of earnings. Yesterday, Israel retaliated for the retaliation, and that too seemed to be more of a controlled attack. So it seems like, at least for now, the two sides are both trying to keep this from escalating into a full-out war in the region, and markets are trading accordingly. Yesterday, after the close, when Israel was set to be launching missiles against Iran, oil skyrocketed, gold skyrocketed, futures sold off in the stock market. By this morning, when it became evident that it was a very limited attack, everything went back to where it was before. And to be determined, obviously, how this goes. It's very unfortunate on a human basis, but it is uncertainty that markets generally do not like. And so we think that this geopolitical tension, whether it be in the Middle East, in Russia with Ukraine, or in China with Taiwan, will continue to be a theme and will continue to be a source of really worry for the markets, which markets generally don't like. That's all we had this week. As always, please let us know if you have any questions. Happy to discuss anything that might be of interest to you in our future series. Have a good weekend.